So we discussed the question number one of the pilot paper of strategic tax planning, which is totally carrying for 50 marks. So you all know that if we go to the paper again. Go to the paper. So at the front page, it is mentioning the guideline. This paper consists of two sections. Section A, for it is a compulsory mark which carries on 50 marks. So section A, we have issue 1, issue different issues, issue 2, issue 3, and issue 4 we treated. So now we got to discuss the issue 5. So the audit committee has flagged a critical liquidity risk when Apex construct private limited the group construction arm, because this is a construction company arising from the government revenue-based fiscal consolidation measures, specifically VAT height, because VAT is previously stood at 15%, now it's become 18%. Now there is a increase, so increment of 3% based on the revenue the company has to pay and remit monthly to the Inland Revenue Department and submit the relevant VAT returns based on taxable period, whether for the export oriented companies 1 month and other companies quarterly basis. Okay, the while VAT must remit monthly on accrual basis based on invoice date. Even though you received or not, accrual means even though you received or not, if you invoice, you have to remit that relevant invoice value, the we call value of supply VAT portion to Inland Revenue Department. Based on the invoice date, the group average data collection period is construction set is structured into 120 days due to tight market conditions. Because now the company's data collection is almost taking 4 months, even though that is not a concern of the IR. You have to anyway remit based on accrual basis, not the cash basis. Okay. The group treasury heads has submitted a memo stating we are effectively acting as a bank for IRD on our monthly billing of approximately 500 million. We remit 9 million, 90 million in VAT immediately, because 500 into 10% means 50. 500 into 18% means it is 90 million. So we have to remit to Inland Revenue Department. However, we don't collect the cash for 4 months because our data collection is 120 months. It means almost the cost 4 months to collect the cash from debtors, because there is a time gap. There is a time value of money we have to pay. Consequently, we are funding this tax payment via our bank overdraft, which is priced at 22% per annum, because we, due to these time limitations, we have to uh, fund the requirement by bank through a bank overdraft or the OD facility. Okay, so here. With reference to issue 5, it realizes the impact of VAT 18% rate affects the working capital, focusing the cash flow mismatch between tax payment and client collection. Assess the financial impact of VAT-driven cash flow mismatch on the group profitability. Evaluate whether the interest expense is deductible for CIT, because that is based on thin capitalization rule, it is allowed. Recommend the strategic administrative remedy available under the VAT Act to permanently resolve this timing mismatch. So if we go to the suggested solution, technical analysis of liability estimate, the IRD assertion like, we discuss fiscal policy and strategic mitigation. Financial, financial impact assessment, the VAT 18% VAT rate creates a severe tax float cost, because that is a cost cash outlay to the company. Calculation interest per month 90 million into 22 per year divided by 12 means 1.65 million you have to pay in order to by having the OD facility to the bank. If I for every single month at payment 90, the company incurs a finance cost 1.65 until the collection. Total exposure within 4 months, the total finance cost is 1.65 into 4 months. It directly erodes the projected margin because you have to pay the interest that is a cash outlay for the company. Deductibility. General rule interest and overdraft are general working capital is deductible under Section 11. It is incurred is the production of income. However, deduction actually limit interest limitation rule we call the incapitalization rule. That is, if there is additional interest that may disallow and carry forward for next immediate finance year of assessment based on the tax relief. To eliminate the cost permanently, we could apply the CGIR for cash-based accounting. Legal basis Section 23 of VAT Act empowers the CGI to authorize specific registered person to account for VAT on payment basis rather than invoice base. Historical, the IRD grant is facility construction and consultancy sectors due to inherent payment delays. Submit a formal application under Section 23 immediately. Once it's approved, VAT liability will be only crystallized when receive payment from the client, aligning cash outflow with inflow and eliminating the OD cost. That is the answer. And you can get the 50 marks, at least 40 marks you can get easily. Thank you.